Joining us now is Oppenheimer Asset Management Chief Investment Strategist John Stoltzfus. He has a S&P target of 5,200. So what do you do when your target's hit, John? Do you say that's enough, or do you just raise your target?
Well, at this point, David, I can't quite tell you what we're going to do with it, but it is under review. When we put it in December, it was one of the highest on the street, and people thought we were nuts. We were looking for about 13% upside from where we were in December when we initiated that target, and then we had it. We saw the market blow through it over the course of the last 2 days. It'll be interesting to see where we close today. But our thoughts are that the fundamentals have improved in spite of an environment wherein many companies, in giving guidance, see their management be very cautious on the outlook. The remarkable thing has been that earnings and revenue growth have been as surprisingly positive as they have been, which has caused a lot of bears to capitulate. Probably our biggest worry now is that so many bears have capitulated this year, now have targets higher than ours, that when everybody joins the same side of the boat, it certainly says we've got to consider what's going on. But the Fed has been remarkably sensitive in applying its mandate over the course of the last 2 years. 11 hikes, 6 pauses. And in effect hasn't pushed the economy into a recession. Job growth remains good. Profitability of corporations actually positive if you look at the S&P 500. And if you consider the consumer remarkably resilient, even as the pace of the economy slows, because when inflation is stickier than it is, people get the message and they make alternative decisions, so to speak.
It's good perspective, John, to remember it was only December when you, as you just pointed out, had one of the higher targets out there, and here we are before the end of the first quarter already having hit it. So, I guess, does that give you pause? And when you speak about the fundamentals, where's the multiple right now? I mean, has it sort of kept up with what encouraged you back in December?
Yeah, we were looking for a multiple by the end of the year, probably around 21 times. With the market we were looking for 5,200 and looking for earnings around 240. It now looks like all that is likely to be exceeded. We're only in the first quarter. Anything can happen now. I mean, I think the most recent lesson was 2022, after 2020 and 2021. Try saying that fast. Resulted in better results than a lot of bears would have expected. 22, a negative pitch book undertook the market with a lot of predictions that didn't actually happen, but dragged the market into a bear market. So where we are today, though, we do think the momentum of the Fed and its sensitivity, being careful not to push even though I won't say it, but being careful not to push the economy into a recession. With likely, we think, cuts in the second half of the year, perhaps as late as the fourth quarter. This looks like a very good environment. And the other thing is the Fed has raised extraordinarily when you consider over the last 2 years, taken the band from 0 to 0.25 to 5.25 to 5.5. But these are much more normal rates than we've seen in years over the last 15 years because of 2 crises back to back. Effectively, what we've got here is more normal rates where bond issuers have to pay for the privilege of borrowing money and bond buyers get something in return. We think that's healthy, and we think it's actually healthy for stocks. I've been in this business for over 40 years now. I came in when Volcker was in his second term, so we have context to add to this. History doesn't repeat itself. It often rhymes, as Mark Twain says, is attributed to. And we think the Fed's doing a good job. The consumer's doing a good job. Business is doing a good job. So we'll see where our target goes. We'll know probably over the weekend sometime.
All right. Well, you keep doing a good job, too, then, John.